Good morning. How is everybody doing today? How is everybody doing today? It's gonna be a pretty chill day in my opinion. I know we got ECB coming up and we got some breaking news here with Chinese stimulus coming down the pipe. But man, it's been an interesting 24 hours, that's for sure. Alrighty, let's hop right on into the charts and I'll get into as to what's going on for the day and what's on the research docket here. Okey-doke. So off the bat, let's start off with checking out NQ. We'll go back to Aussie dollar here in just a sec. So we'll do NQ and then ES to get those two charts out. Oh, hello. Hey, check that out. Did we hit our high from yesterday here? Yeah, we did. It's almost like I said we were gonna do that. Yeah, good indicator, good indicator. So, how about for today? Honestly, I'm not too sure how today's gonna go as far as NQ is. I got higher expectations for Australia and New Zealand today. But first, I'm gonna bring up Eurodollar because that's in the title. I did snag a cheeky little snap, the little tiny little long here on this trade. You can see how I set up my entries here. Went ahead and saw we were at that peak, got a little entry right there, stop at the trough just before the next peak comes in there. And my net expectation is that we'll get a hike out of the ECB today. Hello, Terry. Nice to see you, my man. Let's see here. What else is there? Oh, yes. I just said the Aussie stuff. So, let's see here. Search tab. And pull up Financial Juice real quick. Bum, 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 bum. So, yeah. Scroll down, scroll down. China cuts their RRR by 25 basis points. Effectively, they just made money a lot cheaper. From the outlooks that I've read, they were going to reduce this potentially on Friday by about 10 basis points. But the fact that they did it today and it's 25, guys, in the trade group, I had said something along the lines of, we have to be, actually, it's not even in the trade group. I posted this in the general chat. There's risks of just so many people are expecting things to continue getting worse without people trying to do something about it. So real quick, I'll go ahead and bring it up here on the TradingView chart for you guys to see. You can always hop into the Discord and check this stuff out. But I'll show you here. So yeah, I keep seeing guys all over YouTube saying, oh my god, you know, the US dollar is going to strengthen going into US CPI. And then, dude, you go ahead and you pull up the DXY. Does that look strong? Does that look like the dollar strengthened off of US CPI? No, absolutely not. Now, let me go through this here. A lot of these negative expectations revolve around China and the other G7 countries doing bad throughout the rest of September and throughout October. But I'd argue that there's actually potential positive surprises for China and the rest of the world, and actually negative surprises for the United States. Look, I've had my eye on the ball here. like an actual professional, watching all these strikes go down around the world and watching them like a hawk and staying on top of, you know, for example, the UAW strikes. Every single time Fane uploads a video, does a live stream, every time there's an expert in the automotive business giving their opinion and their analysis on the breakdown, I am there posting that stuff in the Discord. And I open Bloomberg, the front page of Bloomberg today. Look, read these headlines. It's like, what are you guys doing? Biden probably can't stop a strike against big three car makers. Biden scoffs at impeachment. UAW strike standoff has high stakes for key Senate race in Ohio. UAW prepares to strike with contracts talks still in place. Earlier today, I think this top headline said something along the lines of, Biden can do something against the big three. I'm like, what the? President Joe Biden caught between two of his top policy goals, a greener car industry and a labor revival. What's interesting is a lot of the UAW labor that would go into building cars over the rest of this quarter would actually go into building green cars for Ford and GM, you know, electrical cars. Man, oh man. And I'm like, how come Bloomberg is now, only today, on the day of the strike, now just, all four of their top headlines are Biden and the UAW. If you had no expectations about what was going on with the UAW, if you had not been watching this at all, you'd be caught like totally off guard. This is why it's important to do your freaking trade research and read your freaking outlooks. Because there are people like, oh my god, what is this? What's going on? And it's catching them by surprise on the same day as the ECB meeting and giving them all of this crazy uncertainty. And I'm like, where have you guys been for the last 2 weeks? Like, for real. I mean, I post all this stuff for free. All the research that I do, I share it for free in my Discord. Just hop on in and, like, getting all this information is pretty straightforward and easy. It's not hard. You just got to read the stuff. But apparently that's too difficult for some people. However, you are given a pass if English isn't your native language, right? Because a lot of this stuff is written in English, right? Let's see, your prediction on euro dollar. Well, my expectation for euro dollar going in today is that it's going to strengthen. Oh, let me actually bring up some of the research that I found on Twitter. So I have a list of like 200 people who are heads of research and senior economists and chief economists at all these different institutions that are on Twitter, and I just go through it. And man, you can find some awesome stuff on Twitter. Well, now X, right? If you're actually following the right accounts. Otherwise, you know, X could be quite annoying. But before I do that, let me go ahead and set this thing up on the right. But I have some expectations that we could have some negative US surprises coming down the pipe, and some positive surprises for actually China and Russia. Russia is actually, their economy is reaccelerating, and the reacceleration of the Russian economy might give a little bit of a kick to the Chinese. They have their whole housing crisis thing going on right now. But as far as it comes down to energy, yeah, sure, you got that. Some geopolitical stuff at the G20 summit in India. Like, there was no condemnation. There was actually a Reuters article, if I recall, if this is the one here. Yeah, check this out. G20 summit avoids condemning Russia for Ukraine war and calls for peace. I wonder why this is. Probably because Russia's got like a good handful of these G20 countries economically by the balls. They want Russia to re-engage economically with the world, especially considering, I mean, guys, I pulled that USDA global agriculture report up, and a lot of food and wheat and rice production is getting cut, like from natural disasters and poor weather and drought. And one thing that would help is actually getting Russia's fertilizer back on the market. So a lot of people are just trying to be buddy-buddy with Russia so they can at least get some of that. Anyways, on the ECB stuff, because this is pertinent to what's going on right now, right? But we have, like, what, 30 minutes till the ECB meeting, so we got plenty of time to kill and go over all this stuff if we want. Can you maybe share that list if possible, please? What list you referring to exactly? Like, are you talking about like the list of all these resources that I'm going through today? I mean, all this stuff is going to be in the Discord, in all the research channels, my man. But more specifically, let me go through some of this here. So this is Kamil Kovar. He's a senior Eurozone economist at Moody's. We went over some of his tweets yesterday, but he's expecting a 25 basis point rate hike out of the ECB. He was a hawk and expecting that hike before the Reuters article broke. And this is the part that I found interesting about his commentary. And we believe this be the case already for June forecast 2022. ECB is going to increase them further. And now by how much? So he's looking at how much they're going to be changing their 2024 forecast in more significant detail. And it turns out that there are other analysts looking at exactly the same thing. How are they going to change their inflation forecasts over effectively the next 3 quarters here? Now, the next part is this guy, this head of macroeconomic research at Pictet Wealth Management. And he, in his bio on Twitter, is an ECB watcher. And usually the ECB guys who actually put that in their bio on Twitter are, they're on top of any sort of changes going on in the ECB. And he went ahead and he wrote this 2-page report for his own institution, and he shared that publicly. Thank you very much, Frederick. The people meant, oh no, I don't share that. It's a private list just for me. I just keep that for myself. I don't, it's a huge pain just to go through that, adding people, removing people, maintaining that. I don't care to make that public. I'll encourage you to go through Twitter on your own and make one on your own. All you got to do is search like heads of research, heads of the economics department, you know. It's not hard to build these lists at all. Let's see here. Big picture, we'll see a peak in rates either way, but the decision and the wording still matters. So Frederick here, also is expecting for a hawkish hike. Yeah, but I'm still going to be sharing all the resources, Terry, so don't worry. If I go, the other part is if there's like 200 people in the list and like 500 tweets, it's kind of like an insane amount of information. And I just kind of habitually go through it every other day and I'll pull out what I think is interesting and I'll share it in the research channels in my Discord. And then that way it's easier for you. It's easier for you. Yeah, so this guy's hawkish. He goes ahead and gives his reasons. If you check the central bank research channel in the Discord, you'll actually see a link to this particular tweet here. And he goes over, well, if they do hike, if they don't hike, what's going on with this leak. Like, he goes through the hems and the haws of what the ECB is expected to do, what they're not expected to do. But what I like is this commentary is how he brings out, you know, this particular ECB decision has a little more political weight in it because that Reuters leak has tried to push some of the doves, the people who would have voted for a pause, into a precarious decision, because now the market's expecting a hike, and for them to continue to vote on a pause would now cause a somewhat moderate surprise. But depending on who you ask, it's not going to be a surprise, or it is going to be a surprise. I have a feeling that when the ECB result does come out, whatever it's going to be, unless it's literally this, a hawkish hike, and that means the policy and the forecasts show inflation in the future, they hike now, and then they say we may have to hike again come November, December. Like, unless it's explicitly, yes, we are hiking now, and yes, we are raising our inflation forecasts, and yes, we are going to continue putting down the hammer here on the rate hikes, and then all of the other quantitative tightening tools we have in our belt will continue to exercise those going forward, and actually take that into more serious consideration. If it's that kind of hawkish hike, then yeah, it's just going to be unequivocal. Euro's going to appreciate. But anything that's kind of milquetoast, like, okay, this part of the meeting was hawkish, that part of the meeting was dovish, it's going to give you a mixed result, and it's going to do its own thing for, like, the rest of this week. It'll effectively go sideways for the rest of this week. Like, maybe next week there'll be some appreciation because FOMC is expected to pause. And unless there's some sort of economic surprise coming out of Europe, which there very well could be, any sort of positive economic surprise out of Europe would have more weight than just nominal, slight moves down below forecasts. Like, currently, a lot of the forecasts for economic growth are just, well, we're going to see growth accelerate lower. Well, what if growth stops accelerating as slow as forecasted? Well, that would be slightly better, and then that might end up putting the thought into people's heads of, oh, maybe we should take into consideration that maybe a growth pivot might occur in the fourth quarter. The other part when it comes down to at least the FX side of things is the relative rate of it all. See, there are potentially more downside surprises for the United States. And if you know your dollar smile theory, if the United States is getting worse economic data surprises than the rest of the world, then suddenly the US dollar looks a bit less attractive. And one thing that you could look at here, I could pull it up real quick. Is I think this stuff. Yep, right here, US freight. Panama Canal Authority vessel transits may be reduced if drought persists. The Panama Canal can significantly increase the price of consumer goods in the United States going forward here. And I don't know if, you know, this doesn't seem like it's going to affect Europe all that much. There might be a bit of a skew because also the drought's affecting the Mississippi River. The Mississippi River is also having a drought. All of the freight along the Mississippi River in the Gulf and on the east coast of the United States, I mean, even in the West Coast, because I think the unions at some of the ports on the West Coast of the United States just won a big pay increase. All the shipping costs in the United States are going to go up. There could be we could have surprise increases in inflation coming in here around October. Plus, if the UAW strike goes on for 2-3 weeks, that's going to hit growth in the United States also harder on the manufacturing side. I don't know. I see downside surprises on the US side of things and things to remain generally nominal on the European, Aussie, New Zealand, UK side of things, especially if we listen to the guys at the Chinese Beige Book who say all of the commentary about China's economy blowing up are kind of overstated. So I still think there's a serious risk that China does blow up. I'm not going to discount that. But it might be overpriced. It might be overly anticipated and expected that China is absolutely going to be blowing up here. So while it might be the case, there are certainly people working hard around the clock behind the scenes who are trying to make sure China doesn't implode. And if they are successful going into the fourth and the first quarter of this next year, then, I mean, at that point, dollar would probably be weaker over the next 6 months. And I'm just playing around with that theory right now. I'm still in line right now what I'm actually doing with, you know, expecting a consensus view that, okay, the dollar's going to get stronger. The rate of change of growth in all these other countries will probably accelerate. Europe is technically already in recession, and that might continue to accelerate. And China's growth will continue to accelerate lower, and that could, if you know, you have that match light with the housing issue in China. There's so many ways the next like 3 to 6 months can go. It's going to be interesting. It's going to certainly be interesting at a minimum if you're a trader and keeping your eye on all these different sort of risk events coming up. So I'm going to keep my eye on developments with this stuff going on in Panama, the UAW, see how it impacts the growth in inflation in the United States, and see relatively, is the United States growth and inflation matrix getting worse than that of the other G7 countries? And does the economic acceleration in Russia somehow help China, and does China get back on its footing? Because there's still room potentially for that to occur. But then again, you know, there's all the geopolitical issues in China with Xi kind of hunkering himself in politically. I don't know, man. We'll see. We'll see. There's a lot of ways the world can go down. There's a lot of ways this stuff can go down. I just say, be aware surprises can come along. Like I said yesterday here in the Discord. any positive economic surprises in the rest of the G7, China, Russia, would potentially be weighed more now, considering the expectations of dollar strength that are being held by a lot of participants is very, very, very high. So even my base case is to fade any dollar weakness into the latter half of September, but I'm going to stay open and more aware of the risks for positive surprises in China and the rest of the G7. And again, this is in the general chat in the Discord. I'm just pointing out that flip. There's a risk flip potential going on there. I'm not saying it's absolutely going to happen. I'm just saying, hey, that's now on the docket. That's now on the menu. And thank you guys for watching so far. We're 30 minutes in, and we're about 15 minutes away from the ECB rate decision. I'd appreciate it if you guys liked, subscribed, all that good stuff. Keeps me going, keeps me engaged. And let's go ahead and see if there's any breaking news out of Financial Juice here. No, not really. Let's go ahead and check out. Wow, look at all the markets. Japan is high. And if we look at the top, oh my god, the pre-market for is huge for, I think, what is this, the top 10? Yeah, this is this is a custom index that I made of the top 10 assets within the S&P 500, and this also happens to be the top 7 companies within the NASDAQ. And these are all by weight as well. So this is a weighted custom index of the top 10 S&P 500 companies, and this thing is gapping high, man. It is doing well. NASDAQ doing all right. S&P doing all right. I'd be careful if we broke that new high. You're talking 45.10 potentially on the break of that new high. There's still time to reach that, but man, it's gonna have to be like a straight shot up there for like 2 days. Like, it'd have to be volatile and a straight shot to get up there. Let's see here. How about Germany? Germany's down. Germany's down on the day. That ain't good. It's the sick man of Europe. How about Euro stocks? Stocks holding in there. Thank you, Milos, for watching. Yeah, no, it's weighted by like what fraction of the index it is. Yeah, it is weighted though. And yeah, it is weighted by, I believe, market cap. I used someone else's metric for figuring out the right weights. But Aussie is getting a huge boon out of the extra monetary, I think it is monetary stimulus, right? They did that extra 25 basis points of cuts to China's RRR, and that is given the nice little bit of extra kick for Australia. And I mean, also the Japanese are loving it. I mean, they had their gain mostly earlier in this week, so actually no, this was today. Yeah, this is the daily range. Yeah, Australia is really loving it today. Australia and New Zealand getting all the love here. It looks like I closed all my inboxes. Oh well. Let's see here. Let's continue on with the research. So Westpac They're one of the few institutions that I could find that's not expecting a hike here out of the ECB meeting that occurs in about the 13 minutes now. Let's go ahead and check out Danske Bank's daily FX brief. They are hawkish. They are expecting a 25 basis point rate hike, and they have been expecting a rate hike for the better part of a month. Let's see here. Oil prices continue to creep up higher. Yesterday, the IEA warned that output cuts from Saudi Arabia could leave a big supply shortfall in the market. In addition, the US bought another 300, KB, of strategic reserves last week, refilling reserves, tightened supplies. We forecast Brent to average $80 a barrel in Q4. So they see limited upside to oil prices and expect them to drop again during the second half of the quarter, which is interesting. I wonder, I always hate it when outlooks do this. When they go out of their way to say, oh, here's our forecast for an asset's price, and then they don't even give a single sentence of elaboration for why this is the case, because this is not consensus at all. Not consensus at all. Kilo barrels. Okay, gotcha. Gotcha. Thank you very much, Milos. And then BNZ, also this is their markets today. They went ahead and talked about China. Yuan made gains in Asia yesterday, which was expected overnight. China will increase bill sales in Hong Kong to soak up some liquidity. Implied 3-month CNH interest rates have moved sharply higher, now above 4%. This is the latest in a series of measures undertaken by the PBOC aimed at stabilizing the yuan to discourage speculative short positions. So the Chinese government is doing something, trying to stabilize their economy, and hopefully they win, because that actually would be fairly risk-on. But man, there's a lot of tides coming up against them in their efforts to achieve that. But more to the point, outside of that 25 basis point RRR surprise out of China, we also got better employment data out of Australia. So again, going back to that earlier commentary that I gave of watch out for positive surprises out of the rest of the G7, Russia and China, to potentially offset any of those dollar gains that have been made, especially if those strikes and all the drought for these freight and shipping costs rise for the United States. It could slow growth in the United States further and raise inflation in the United States faster and make the United States not as attractive if the rest of the world kind of gets back on its feet a little bit. We'll have to see more data come out like this. But the fact that I gave that commentary last night and then today we're already starting to see some positive surprises exactly along those lines, I'm like, oh, that was fast. That was very, very fast. And now I just want to see more. I just want to see a lot more of these surprises to actually kind of confirm that expectation, that new pet theory, because I'm still like 60-70% on board with, yeah, dollar probably gets stronger from here. That is still my nominal case, but I am ready, willing, and able, and always on top of the latest research and economic data to see if this move is actually happening. So, any more positive surprises out of the rest of the world? The G7, Russia, China? That'd be great for those currencies. That'd be great for those countries. But it's also going to be determined by if the relative growth compared to the United States, those countries in the United States, is improving. So continuing on, that's just the Westpac monthly outlook. This is the New Zealand dollar outlook. Buddy, check this out. Where was it? If we were to see export prices in the terms of trade fall further within New Zealand in line with prior historical episodes similar to the Great Financial Crisis, then Westpac would assume a weakening of the New Zealand dollar further. So remember, base case scenario is still for, stuff to hit the fan. And in such a scenario, we would see another 10% fall in the TWI and New Zealand dollar exchange rate. And I believe the TWI is the primary stock market index for New Zealand equities. Yeah, and that's short-term energy outlook. Oh yeah, a new piece that came out today by Wells Fargo, The Rise of Deglobalization, International Commentary. Man, Brendan knocks out some good commentary, man. But yeah, you can find this in the Outlooks channel, in the Plan the Profit Discord, and it's a multi-part series, and this is the first part. I'm going to be giving this a read later today. Good stuff. Let's see, what else is there? And this is a podcast, this monthly outlook by Westpac, right? So the people at Westpac did a podcast covering that monthly outlook. So if you wanted something to listen to instead of read through, if that's too hard for you, you can listen to them here. And they say, hey, we have an outlook all the way out to 2025. Good on you. And then here's Wells Fargo's analysis on August CPI. They go ahead and give a breakdown here. It doesn't really change their expectations, is what I got out of it. And then this, RBC. This is a bank out of Canada. And they're like, dude, Canada is slowing down really hard. Canada is really kind of getting a bit sluggish here. So if you want a very thorough breakdown of the Canadian economy by Canadian province, this is actually not a bad place to start if you want to start getting familiarized with the Canadian economy. It's a whole macroeconomic breakdown and outlook going out for the quarters ahead here. All right, we are 5 minutes away from the RBA rate decision. And when that comes out, I will be turning on the good old financial juice. The good old squawk chat, my man. And frankly, any way the rate hike comes out, I'm prepared in both scenarios for if it comes out flat or if it comes out higher. Yeah, my man. I am looking forward to this rate decision. I'm interested to see if the ECB will cave to the theory that, right now the theory is that Reuters article that came out and kind of surprised the market and moved the market odds towards a plus 70% probability of a rate hike was actually leaked by a hawk at the ECB in order to induce the doves to hike in line with the new expectations. So it'll be interesting to see if there's some political shenanigans going on within the ECB, and the doves, because of that, kind of say, no, this is bullshit. We're going to stick our ground. We're going to stay dovish, and we're not going to vote on a hike. And this is going to kind of be pulling the guard both ways here, whether or not that she can actually get the doves and the hawks to actually come to any kind of consensus. So we'll see what kind of deal that they come to, and we'll see what kind of impact it has on the markets when it comes out. This really can come out in any sort of spaghetti-o ways as far as how hawkish or how dovish this could come out. So we'll just have to see. A lot of uncertainty abound. But people and analysts feel pretty confident about expecting the hike. It's just now, what else do they do as far as their quantitative tightening tools, right? And what kind of forward guidance do they give? And what are their forecasts for inflation? Do they actually have forecasts for inflation in 2024 to actually come out above 3%, like the leak from Reuters said? So we'll see. We'll see. All right. We are 2 minutes away, less than a minute, actually about a minute and a half away now from the ECB rate hike, you guys. I'm going to go ahead and turn on the Squawk chat here at Financial Jews. Let me know what you guys are doing ahead here into the ECB. And I'll go ahead, hide the research, bring up the euro dollar on a 5 minute here. Hide the drawings, let you guys see what's going on very clearly.
1 minute to go now. I'll be leading with the ECB interest rate decision.
There we go, 30 seconds. Alrighty. We're seeing the spreads on the exchange start to widen. The bid-ask spread is widening here. Whoa! I wonder what happened.
Hike 25 basis point, hike 25 basis point, hike to 4.5% higher than the expected, no change. ECB deposit rate, hike 25 basis point, hike 25 basis point, hike to 4% higher than the expected, no change. Taking a look at the rate statement here, the ECB says in order to reinforce progress towards its target, the ECB today decided to raise 3 interest rates by 25 basis points.
Whoa!
By 25 basis points, the ECB further says the rate increase today reflects the ECB's assessment of inflation outlook in light of incoming economic and financial data and dynamics of underlying inflation and strength of monetary policy.
Check that out.
ECB say they now expect the euro area economy to expand by 0.7% in 2023, 1% in 2024, and 1.5% in 2025. The ECB says, based on its current assessment, the ECB considers that interest rates have reached levels that, maintained for a sufficiently long duration, will make a substantial contribution to timely. The ECB adds by saying ECB's future decisions will ensure that interest rates will be set at sufficiently restrictive levels for as long as necessary. Adding by saying, in particular, the ECB's interest rate decisions will be based on its assessment of inflation outlook in light of incoming economic and financial data, dynamics of underlying inflation.
Man.
The ECB says accordingly, interest rate on main refinancing operations and interest rates on marginally lending facility and deposit facility will be increased to 4.5%, 4.75%, and 4% respectively. The ECB adds by saying, as concerns PEPP, ECB intends to reinvest principal payments from maturing securities purchased under program until at least the end of 2024. Adding by saying they see 2023 inflation at 5.6% on the prior forecast of 5.4%. The ECB's new inflation projections sit at 5.6% in 2023, 3.2% in 2024, and 2.1% in 2025.
Wow.
PEPP reinvestment to run until at least the end of 2024. And it
still went down. They hiked and it still went down.
The ECB further says inflation continues to decline, but is still expected to remain too high for too long. Saying the upward revision for 2023 and 2024 inflation mainly reflects a higher path for energy prices.
I'm currently looking at this here, and I'm thinking of stepping in again.
The ECB says in order to reinforce progress towards its target, the ECB today decided to raise 3 interest rates by 25 basis points. The ECB say the Governing Council considers that the key ECB interest rates have reached levels that, maintained for a sufficiently long duration, will make a substantial contribution to the timely return. The ECB says with increasing impact of this tightening on domestic demand and weakening international trade environment, the ECB staff have lowered their economic growth projections significantly, further saying that ECB's past interest rate increases continue to be transmitted forcefully. The ECB say that ECB staff have slightly revised down projected path for inflation, excluding energy and food, to an average of 5.1% in 2023, 2.9% in 2024, and 2.2% in 2025.
Man, that's a lot.
The ECB say they see 2024 inflation at prior forecast 3%.
That's a lot of information, but I heard inflation expectations higher out of the ECB.
ECB sees 2024 inflation, excluding food and energy, at 2.9% versus 3%.
Man. ECB staff have slightly revised down the projected path for inflation, excluding energy and food, so core.
The ECB sees 2023 GDP at 0.7% on the prior forecast of 0.9%.
So they see 2024 core inflation at 2.9 versus 3, so it's a slight downwards revision to
the
core
ECB
inflation.
Say the APP portfolio is declining at a measured and predictable pace. The ECB also see 2024 GDP at 1% on the prior forecast 1.5%, seeing 2025 GDP at 1.5% on the prior forecast of 1.6%.
Yeah. Taking all this in, let me go ahead and bring up the report here. So they've raised their interest rates. So this is what we want: the September ECB staff economic projections for the euro area. Do they have a chart of the projections? No chart. Oh, wow. They revised 2024 GDP down by 0.5%. And they also revised this year's GDP down by 20 basis points. That is not good. That is really not good. Even, yeah, so they're hiking into a slowdown. So they must be really concerned about inflation over the next 6 months. And it doesn't seem like they're particularly... Yeah, they'll just run over any growth that actually happens. They'll keep diving growth. But man, it's... I mean, I keep looking at this spot here and I'm like, is it a decent spot to hop in? But then I look at this and I'm like, dude, this is like the future expectations are bad. here. Future expectations got really bad here. The Governing Council considers that the key ECB interest rates have reached levels that, maintained for sufficiently long duration, will make a substantial contribution to the timely return. That's them saying, in all too many words, we're probably at terminal rates now. Man. So, ECB's probably at the terminal rate, and that will likely be the expectation in a lot of the outlooks getting printed here over the next 48 hours for the week ahead. ECB probably at terminal rate now, guys. Yeah, dude, and that lower GDP forecast just across the board, and especially that 0.5 point forecast lower. Here, I'll bring up Financial Juice. Yeah, check that out. This one right here. ECBC's 2024 GDP at 1%, and the prior forecast was 1.5%. That's bad. That's real bad. Yeah, you know, the Eurodollar shorts are probably doing all right, but I still don't know short term if this is gonna lead Euro down to the 106 level, like, by end of week. Like, I'm sure that everyone will have negative expectations for the Euro going forward. But if the ECB really is at the terminal rate now, yeah, this is now still pretty dicey. This is still pretty dicey in my opinion. Even, like, it's not bearish enough to short off of in the short term, simply because they did hike. And it's not bullish enough to swing off this decision lower for like 2, 3, 4, 5, 6 months just based off this one decision. Because these forecasts can flip on a dime. And remember what I said during literally the first half of the stream, which is there's real risks of positive surprises coming out for the rest of the G7, and that includes Europe. And those positive surprises would get weighed a lot more because they would be a bigger surprise. So I'd just be cautious. I'd be more cautious going short the rest of the G7 going forward. Like, I'd want to tiptoe as we go through economic events to make sure that any sort of rebound actually does not follow through going into the fourth quarter. And I'm sure, you know, again, the nominal case is that the slowdown across the developed world is going to occur. But there's a non-zero chance that some sort of rebound, some economic surprises come in, and you get some volatile, choppy markets into the fourth quarter. Do not take any forecast today for granted a month from now. Isaac, Eurodollar shorts for next week. Yeah, that could be on the table. Certainly. Let's check out the yield differentials here. Oh! Yield differentials on the intermediate term are actually on the positive side for the 12-hour chart. How about on the day? I mean, on the day, it's still green. Yeah, dude, this is super mixed. The only negative part on the yield differential sign for Eurodollar is the long-term lagging stuff. And if you knock that out, you're just left with a bunch of green, just moderate green. I don't know, man. My expectation for this down move, like, I gotta see these yields go red. I gotta see these yields differentials go red now. If these yield differentials don't, like, start going red going forward here, then the dollar bulls could get run over because there's no FOMC rate hike anticipated on the 20th when the Fed comes to the market. They're probably going to hike in November. I mean, there was a big thing out of Financial Juice. Sorry about that. I had the thing. I had the research up and the market at the same time. So let's see here. Where's that city thing? City. Oh, there you go. Citi expects Fed to skip the rate hike in September and deliver a 25 basis point rate hike in November. And this is effectively consensus for the FOMC. Now, the Fed holding, unless the economic data just continues to get weaker here over the rest of September and the rest of October. Oh, US PPI just came out. Higher than anticipated. Yeah, man, this is actually probably gonna... That PPI just came out higher. Things just moved real freaking fast. I wonder how much that changed the probabilities for a rate hike. And also, look, there you go. There's your red on the yield differentials, on the yield spreads. I mean, my face cam is kind of blocking it, but... Let me see. Can I... Let's see here. Location, bottom left. There you go. Now you can see it. All these yield differentials are flipping red. So I'm actually getting what I anticipated now to actually go down here. So yeah. Bye-bye, Euro. Lord, oh Lord. That was a volatile mess. A volatile mess. Again, I'm not totally sold. You can see we're at a peak here in the low, but again, that's not positive on the yield differential side here. I don't know. My view is still to remain fairly tactical here going into the end of the month. Yeah, my view is still to remain fairly tactical going into end of month. Like, yeah, all these future expectations are really, really bad. But now it's like, dude, how much more do you want it to give? But yeah, that was a more interesting peak to trade. I mean, I have on another screen my trading window, and I caught a trade there on the long side. I did get stopped out up here at these prices. Up here. So I was pretty much saved on these trades. That's all well and good. And I took a shot here, but I don't know if this is gonna pan out or not. We'll see. We'll see. Yeah, again, this is really, really... That PPI came out super strong. Again, check this out. Here's the PPI report. Look at that. US retail sales jumped super high, way above forecast. PPI year over year jumped. PPI month over month jumped. Yeah, I wonder if this is actually in a meaningful way going to increase the rate hike odds over at the FOMC or not. Like, is this enough to actually move the FOMC? I'm sure some rate hike odds are going to go up, right? Oh, yeah, no, I did get stopped out on those. I was, when I saw the rate hike odd come out, oh, there's the press conference from the ECB. Oh, boy. No, now we're going to get Lagarde coming out, and the market's going to chop around based off what she has to say here. Oh, this is just gonna be great. Today is just gonna be so much chop. Yeah, I mean, first you have the ECB hike, and then you have the PPI putting the kibosh on this. And now you're gonna have Lagarde come out and give us some more chop here. Man, oh man. Let's see here. What else is there? Jobless claims went down. Core PPI stayed flat. Okay, so it's headline. The headline moved. Canadian wholesale went lower. Oh no. How is the CAD doing? CAD's there. Let's see here. USD, CAD. It rose a bit. It's at a likely low. Likely low on the day. Let's see here. Yeah, Euro just got smacked. Just got smacked hard. Same thing with the pound. It reacted really harshly to that PPI. Aussie gave back its gains. How about New Zealand? Yeah, even New Zealand. Yeah, New Zealand fell a bit harder. Still holding the 59 level there. So yeah, well, let's see here. When she expected to come on? And about 4 minutes from now, she's expected to come on. Man, this is going to be a bit of a long stream, huh? But man, that PPI really kicked everyone's butt today, huh? But that means inflation is accelerating inside of the United States, which is actually which is actually one of the things I said might be bad for the US. Retail sales going higher. Interesting. I mean, the big thing is that growth in the Eurozone got the forecasts for growth in the Eurozone just plummeted. And then you got this reacceleration in inflation here on the US side, which has increased rate hike odds for the FOMC. But I don't think that's going to materially change that the Fed will probably pause here in September. Again, thank you guys for watching. We're now like, what, more than an hour into the stream. Currently waiting on Lagarde to come out, give her speech, probably take questions from the media. Hopefully one of those questions is kind of around what the internal debates and topics were about when it came down to discussing that leak from Reuters. And maybe what they do in the future to prevent any further leaks, you know? But everybody knows that. Everybody knows they're never going to stop putting out those leaks. Oh, look, that probably is the low on the day for New Zealand dollar. Euro dollar kind of rebounding off that low, but is it gonna hold going in the next week? I don't know. We're probably gonna stay below the 107 level going into next week, but yeah, like this is definitely a very tactical period ahead of us for next week. Yeah, Aussie's pretty strong too, I bet. Yeah, it's rebounding some of its gains. Yeah, Aussie's holding up real nicely here. I think the news out of China is it's like definitely more of a tactician in the week ahead here than having very strong biases, because any sort of surprise, any sort of positive surprise could totally upend positioning in the US dollar. Absolutely, James. And we're still not done for the day. We still have Lagarde coming up here. I mean, I'm kind of arguing whether or not we should listen, but she should be speaking right about now. Yeah, 5:45. Chart says 5:45. She should be speaking right now. Maybe the live... Yep, there she is. Man, next 48 hours are going to be pretty interesting. I wonder what everyone's going to be writing in their outlooks. I really, really, really am curious what the outlooks are going to say. Let's bring up the euro dollar here. Oh, that euro is rebounding. All right, press laving. We're gonna get Lagarde speaking. Almost time for a refill.
Good afternoon and welcome to our press conference. I'm joined on stage by President Lagarde and Vice President de Guindos. My name is Wolfgang Preußel. For our online participants, if you ask a question, please turn on your cameras and your microphones. And with that, I hand over to President Lagarde. Please.
Get ready for the snooze fest.
Thank you so much and welcome to all of you after this summer break that I hope you enjoyed. The Vice President and I welcome you to our press conference. Inflation continues to decline, but is still expected to remain too high for too long. We are determined to ensure that inflation returns to our 2% medium-term target in a timely manner. In order to reinforce progress towards our target, the Governing Council today decided to raise the three key ECB interest rates by 25 basis points. The rate increase today reflects our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. The September ECB staff macroeconomic projections for the euro area see average inflation at 5.6% in 23, 3.2% in 24, and 2.1% in 2025. This is an upward revision for 23 and 24 and a downward revision for 25. The upward revision for 23 and 24 mainly reflects a higher path for energy prices. Underlying price pressures remain high, even though most indicators have started to ease. ECB staff have slightly revised down the projected path for inflation, excluding energy and food, to an average of 5.1% in 23, 2.9% in 24, and 2.2% in 25. Our past interest rate increases continue to be transmitted forcefully. Financing conditions have tightened further and are increasingly dampening demand, which is an important factor in bringing inflation back to target. With the increasing impact of our tightening on domestic demand and the weakening international trade environment, ECB staff have lowered their economic growth projections significantly. They now expect the euro area economy to expand by 0.7% in 23, 1% in 24, and 1.5% in 25. Based on our current assessment, we consider that the key ECB interest rates have reached levels that, maintained for a sufficiently long duration, will make a substantial contribution to the timely return of inflation to our target. Our future decisions will ensure that the key ECB interest rates will be set at sufficiently restrictive levels for as long as necessary. We will continue to follow a data-dependent approach to determining the appropriate level
Low end
and
for the day on the
duration
euro
of
dollar now.
restrictions. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. The decisions taken today are set out in a press release which is available on our website. I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. So turning to the economic activity. The economy is likely to remain subdued in the coming months. It broadly stagnated over the first half of the year, and recent indicators suggest it has also been weak in the third quarter. Lower demand for the euro area's exports and the impact of tight financing conditions are dampening growth, including through lower residential and business investment. The services sector, which had so far been resilient, is now also weakening. Over time, economic momentum should pick up as real income are expected to rise, supported by falling inflation, rising wages, and a strong labor market, and this will underpin consumer spending. The labor market has so far remained resilient despite the slowing economy. The unemployment rate stayed at its historical low of 6.4% in July. While employment grew by 0.2% in the second quarter, momentum is slowing. The services sector, which has been a major driver of employment growth since 2022 is now also creating fewer jobs. As the energy crisis fades, governments should continue to roll back the related support measures. This is essential to avoid driving up medium-term inflationary pressures, which would otherwise call for an even stronger monetary policy response. Fiscal policies should be designed to make our economy more productive and to gradually bring down high public debt. Policies to enhance the euro area's supply capacity, which should be supported by the full implementation of the Next Generation EU programme, can help reduce price pressures in the medium term while supporting the green transition. The reform of the EU's economic governance framework should be concluded before the end of this year, and progress towards capital market union should be accelerated. Looking now at inflation. Inflation declined to 5.3% in July, but remained at that level in August, according to Eurostat's flash estimate. Its decline was interrupted because energy prices rose compared with July. Food price inflation has come down from its peak in March, but was still almost 10% in August. In the coming months, the sharp price increases recorded in the autumn of 2022 will drop out of the yearly rates, thus pulling inflation down. Inflation, excluding energy and food, fell to 5.3% in August from 5.5% in July. Goods inflation declined to 4.8% in August from 5% in July and 5.5% in June, owing to better supply conditions, previous drops in energy prices, easing price pressures in the earlier stages of production chain, and weaker demand. Services inflation edged down to 5.5%, but was still kept up by strong spending on holidays and travel and by the high growth of wages. The annual growth rate of compensation per employee remained constant at 5.5% in the second quarter of the year. The contribution of labor cost to annual domestic inflation increased in the second quarter, in part owing to weaker productivity, while the contribution of profits fell for the first time since early 2022. Most measures of underlying inflation are starting to fall as demand and supply have become more aligned and the contribution of past energy price increases is fading out. At the same time, domestic price pressures remain strong. Most measures of longer-term inflation expectations currently stand at around 2%, but some indicators have increased and need to be monitored closely. So what's our risk assessment? The risks to economic growth are tilted to the downside. Growth could be slower if the effects of monetary policy are more forceful than expected, or if the world economy weakens, for instance, owing to a further slowdown in China. Conversely, growth could be higher than projected if the strong labor market, rising real incomes, and receding uncertainty mean that people and businesses become more confident and spend more. Upside risks to inflation include potential renewed upward pressures on the cost of energy and food. Adverse weather conditions and the unfolding climate crisis more broadly could push food prices up by more than expected. A lasting rise in inflation expectations above our target or higher than anticipated increases in wages or profit margins could also drive inflation higher, including over the medium term. By contrast, weaker demand, for example due to a stronger transmission of monetary policy or a worsening of the economic environment outside the euro area, would lead to lower price pressures, especially over the medium term. Turning now to the financial and monetary conditions. Our monetary policy tightening continues to be transmitted strongly to broader financing conditions. Funding has again become more expensive for banks as savers are replacing overnight deposits with time deposits that pay more interest, and the ECB's targeted longer-term refinancing operations are being phased out. Average lending rates for business loans and mortgages continued to increase in July to 4.9% and 3.8% respectively. Credit dynamics have weakened further. Loans to firms grew at an annual rate of 2.2% in July, down from 3% in June. Loans to households also grew less strongly, by 1.3% after 1.7% in June. In annualized terms, based on the last 3 months of data, household loans declined by 0.8%, which is the strongest contraction since the start of the euro. Amid weak lending and the reduction in the euro system balance sheet, the annual growth rate of M3 fell from 0.6% in June to an all-time low of minus 0.4% in July. In annualized terms over the past 3 months, M3 contracted by 1.5%. So in conclusion, inflation continues to decline, but is still expected to remain too high for too long. We are determined to ensure that inflation returns to our 2% medium-term target in a timely manner. In order to reinforce progress towards our target, the Governing Council today decided to raise the 3 key ECB interest rates by 25 basis points. Based on our current assessment, we consider that the key ECB interest rates have reached levels that, maintained for a sufficiently long duration, will make a substantial contribution to the timely return of inflation to our target. Our future decisions will ensure that the key ECB interest rates will be set at sufficiently restrictive levels for as long as necessary. We will continue to follow a data-dependent approach to determining the appropriate level and duration of restriction. In any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation returns to our medium-term target and to preserve the smooth functioning of monetary policy transmission. We are now ready to take your questions.
Thank you, Madame Lagarde. And the first question goes to Annette Weisbach of CNBC. Annette, please.
Now it gets interesting.
President Lagarde, thank you very
Hopefully.
much. My first question would go, a general one. How did the discussion go? Because clearly before going into the meeting, there was much room for the so-called doves, but also the hawks. So how did you come to a compromise? And the second question, is that a dovish hike, meaning that's it now? Or is it a hawkish pause? Of course not a hawkish pause, but is that the end of the rate hiking cycle, or do you leave the door open?
Thank you very much for your 2 questions. So how did the discussion go? We had a lot of data, a lot of analysis done by staff, and obviously this was a projection meeting and projections that was prepared by the ECB staff. So we looked very closely at all those data. And to give you an example, we spent hours and hours yesterday, morning and afternoon, with the usual presentation by staff in the morning and by the chief economist and the member of the executive board responsible for markets, to have as much as possible intelligence, numbers, analysis. And I'm pleased to say that at the end of this morning session, we came to the conclusion that we shared the analysis that was conducted on GDP, on inflation, on anticipation. And obviously some members did not draw the same conclusion. And some governors would have preferred to pause and reserve future decision once more certainty, more intelligence would have resulted from the passing of time and the impact of our many previous decisions. But I can tell you that there was a solid majority of the governors to agree with the decision that we have made and that I have just read to you. So yes, there are a few members in the Governing Council who would have preferred another one, and we had to rely, as I told you, on a solid majority. It is not the practice to give numbers of who did what and when, but suffice to say that the majority was solid. And it was a very, I don't want you to believe that we had an antagonistic adversarial discussion. We really went deep into the numbers and the analysis and tried to really take into account the sensitivity analysis, the scenarios that were provided by staff, really discuss the baseline and the impact of our measures in the past. And I'm happy to go through the process that we followed in terms of reasoning. Now, on your second question, is the door open or is the door closed? It was a beautiful theater play by Marivaux who said that a door has to be either opened or closed. But this is theater. And what we have decided is actually reflected in that key paragraph, which I have read twice because it is in the body of the text, which was released to you earlier, and also in the conclusion of the text, which is that, and it has caveats, based on our current assessment. So it is based on all the data, the numbers, the analysis, the assessment, the projections, and any other information that we have available. We consider that the key ECB interest rates have reached levels, okay, note levels, that, maintained for sufficient long duration. So there is the time element that comes up, will make a substantial contribution, those are heavy words, to the timely return of inflation to our target. And that we don't stop here. The whole paragraph is important and needs to be read in symbiosis. So the next sentence says, our future decisions will ensure that the key ECB rates will be set at, repeating, sufficiently restrictive level. That's number one. For as long as necessary.
Market likes that.
Really two parameters that are going to guide us very much. Not that we are
Market likes
about
that.
the three components that have guided our reasoning so far. And we continue. We will continue to follow a data-dependent approach. You've heard that before. Data-dependent approach to determining the appropriate level and duration of restrictions. In particular, our interest rate decisions.
So this might not actually be the last one.
And I repeat there, it's in the text. Number one, inflation outlook in the light of the incoming economic and financial data. Number two, the dynamics of underlying inflation. Number three, the strength
future
of
rate hikes are getting
monetary
priced
policy
in right now. November could
that
possibly getting
addresses,
priced in.
your question, and I think that the exegesis that no doubt some of you will conduct in relation to substantial contribution and how that substantial contribution
there we go.
contributes to
Something interesting.
sufficient, means significant level maintained for as long as necessary based on current assessment gives you the answer to your question. Thank you.
Thank you. Now turning to our online participants, I'd like to give the floor to Balazs Korani of Reuters. Balazs, please.
Good afternoon. Thank you so much for taking my questions. First question is about asset purchases, President Lagarde.
This will be
Is
good.
2024 carved in stone for PEP reinvestments? And if not, do you expect a discussion on the APP do you expect a discussion about outright sales of bonds? The second question is about the growth outlook, which is about, I guess the question is whether a recession is becoming your base case for the Eurozone. Do you expect a recession perhaps in the third and fourth quarters, or do you still believe that the quarterly numbers continue to remain positive?
Thank you very much for your two questions. On your first question, we regard interest rates as the key tool in the work that we are doing in order to reach our 2% medium-term target. So we have not discussed the PEP program and the reinvestment and the forward guidance. PEP is our flexibility instrument, as you know, and is the first line of defense if we want to defend proper transmission of our monetary policy. We have not either discussed any kind of APP outright sale. And on your second question, I want to... Sorry, you're missing a little bit of happening here on the floor because something is falling. But you're not with us, so I have to tell you what's going on here. So, you are correct, Balázs, that the GDP has been revised significantly. We moved from 0.9 to 0.7 in 23, and more importantly, we moved from the 1.5 to 1% in 24. But let me just take a moment to explain to you what seems like the biggest revision, which is 2024. Most of it, actually 3/4 of that revision, 0.5, is actually attributable to carry over from 23. So we are going through a period of about 5 quarters of very, very sluggish growth. And we are, based on our projection, coming to the end of it. And the pickup, according to the same calendar, the same quarter calendar that we have had in the June projections, picks up again in 24. The downgrade from 1.5 to 1, as I said, is carryover from 23. In 25, we have a small revision, and we move from 1.6 to 1.5, which is really a minimal revision. But in essence, the recovery that we had planned for the second half of 23 is actually pushed out into time for various reasons that I'm happy to expand upon. But that's what we are seeing.
All right.
Thank you. And the next question goes to Alex Weber of Bloomberg. Alex, please.
Good afternoon. Here.
Where are you?
I'm over here.
Oh, yeah.
2 questions as usual. You say that the current level of interest rates will make a substantial contribution to fighting inflation if maintained for a sufficiently long period of time. Did you have a discussion in the Governing Council what sufficiently long means in practice, for how long rates will have to stay at the peak at the very least? And then as recently as when you gave a speech in Sintra, you said the ECB is unlikely to be able to call the peak in interest rates in the near future. Just wondering what exactly made you decide that now's the time to at least allude to the fact more strongly. Thank you.
You know, I'm not going to annoy you with the rereading, but you obviously all picked up that the level, our two key determination are level sufficiently restrictive for long enough so that we are confident that we are reaching the 2% medium-term target. And as indicated in that paragraph that I have read, under current assessment, we believe that the interest rates that we decide will provide a substantial contribution to that target. But with the 2 elements, sufficiently restrictive, number 1, for long enough. Now, your real question is, did you discuss the long enough? And the answer to that is no, because we're also saying in the same breath that we will be data dependent. So what we want to do is continue to be data dependent, and test our assessment that I have just described for you against future projections and subsequent assessment. That's what we are tasked to do, with the determination to reach the 2% medium-term target in a timely manner. Now, you had a second question. Oh yeah, Sintra.
Speech.
You know, we are not saying, I'm not changing anything from Sintra. I stand by what I said and I wrote in Sintra. And we are not either saying that we are now at peak. I think the sentence that I read is really the critical one. With today's decision, we have made sufficient contributions under current assessment to returning inflation to target in a timely manner. And as I said, both elements matter: the level, sufficiently restrictive, and the duration. But it's obvious that the focus is probably going to move a bit more to the duration, but it is not to say, because we can't say that now, that we are at peak.
Right. And the next
So
question.
I know it's complicated because the as long as necessary cannot be actually pinned down, and the substantial contribution cannot be either pinned down, because it's every time an assessment that we have to conduct against the data, against the analysis, against the various information that we derive from experts, and against the projections and what our staff offers.
Okay, thank you. And now the next question goes to Aude Kerselek of BFM Business. Aude, please.
Thank you for having my question. At Jackson Hole, you told that the ECB has to maintain its credibility with the public. How do you evaluate the ECB's current credibility? And second question is, 15 years after Lehman collapse, do you think that banking system in Europe is safe from such a crisis? And what about the shadow banking?
Those are big questions, you know. So, on credibility of a central bank, I know that the experts will give you probably a lot of measurements and surveys and indicators to determine whether the central bank, ours or any other central bank, is credible, is losing credibility, is gaining credibility. What I know is that the ECB is on a positive path directionally. But my definition of credibility is that we deliver on our mandate. Our credibility on the line is to reach the 2% medium term in a timely manner. And we will do everything we have to do in order to deliver on that. That's credibility. You have a mandate, you have to deliver against that mandate. On the stability and strength of banks, my dear Vice President.
Good afternoon.
Oh, thanks.
Well, 15 years after Lehman, I think that's
pretty good discussions
of the banking industry in Europe is totally different. Banks are much more resilient. This is something that we have reiterated several times. The capital levels, the quality and the level of liquidity are not comparable to the situation 15 years ago. And I think that makes a big difference. And I think that we have a very good example, what happened in March. In the US and with Credit Suisse, you know, these kind of events didn't have any impact on the European banks. And after that, we had our stress test exercise that indicated that the European banks, that they are resilient, that they can withstand even, you know, a very severe scenario. And I think that this is a proof that the situation has changed quite a lot for better. Perhaps now the attention is much more on the non-bank part of the financial system. I think that there, you know, in terms of financial stability, we have identified many more vulnerabilities now, but and you know, that's the focus of attention that we are putting now in terms of financial stability.
Thank you, Vice President. The next question would go to Martin Arnold of the Financial Times. Martin, please.
Thank you. President Lagarde, 2 questions from me. Firstly, what do you say to people who might accuse you of making a likely recession worse and adding to the woes of the Eurozone economy? Second question is to ask you whether the expectations that national central banks and the European Central Bank are likely to make sizable losses in coming years, is that having any impact on your discussions? Is that something that is having any impact on your decisions at the ECB? Thank you.
Well, thank you very much, Martin. I will dispose of the second because I think it's going to be a fast response to your point about whether the likelihood or possibility of national central banks or the ECB to make loss, does that impact on our decision-making process and our decision? The answer to that is no. Because, and in a way it addresses also now your first question, no, because the objective that we have, the mandate that we were given is price stability. It is not to make profit. It is to procure price stability within the euro area. And I would observe that the fight that we are leading, we're not the only one, but the fight that we're leading against inflation is making progress. And what we're doing today is trying to reinforce that progress. Remember back in October, we were at 10.6. We're down to 5.3 now. So it's been divided by half. Is it satisfactory? No, because it is, and it is expected by our projection to still remain too high and for too long. But inflation has declined, and we want it to continue to decline and to reinforce that process. And we're doing that not because we want to force a recession, but because we want price stability to be there for people who are taking the brunt of inflation, high prices, and predominantly so those who are not the most privileged people.
Thank you, President Lagarde. And the next question goes to M&I, let me just check.
Good old M&I.
Santiago Pinol, I'm sorry. Santiago, please.
From Spain?
Santiago Pinol of M&I.
Hello, good afternoon. My question is, if the data dependent and held for long are at odds at each other, and if this can be contradictory, and if you are prepared to cut rates if growth slows further. In other words, it's sufficiently restrictive, that sentence could imply a cut. Thank you.
Quite a move when M&I comes out.
This is not even a word that we have pronounced. But yes, the data dependency applies to both the determination of the sufficiently restrictive level as well as the length of time where it has to stay at that level. So we don't see any contradiction in terms in having the two components in the same sentence. One will drive the other, actually. And on your other, I think I addressed your second one.
Thank you. Then Christian Siedenbiel of Frankfurter Allgemeine Zeitung. Christian, please.
Yes, thank you. Good afternoon. Madame Lagarde, how much are the problems in the real estate market affecting the ECB?
Well, thank you for the question, because that's certainly an area, whether you're looking at residential real estate, which affects, obviously, at the end of the day, households and people, or whether you look at commercial real estate, this is a sector that is clearly responding very much to the current circumstances. The level of interest rates and the financing tightening that we are conducting to bring inflation down is one of the factors that that cause this overall real estate sector to be to be in a difficult situation at the moment. I mean, we're not oblivious to it, we know it. And, you know, as I said to Mr. Arnold earlier on, we are not driven to sustain and support a particular sector. We are driven by the imperative of delivering on our mandate, which is price stability. And we want to do that timely.
Thank you. And the next question goes to Eshe Nelson of the New York Times. Eshe, please.
Good afternoon. I'm Isha Nelson from the New York Times. Can I ask for your assessment on the pace and the strength of the transmission of monetary policy? You noted the fastest contraction in household loans. Do you feel that monetary policy is transmitting as quickly as you would like, too quickly, too strongly, or slow enough? And then in the past, you've talked a lot about the ability for wages to keep rising as long as companies absorb those labor costs in their profits. Are you starting to see that be possible, or is there a risk of either kind of wages diminishing or profits returning to where they were?
Well, thank you so much for the two questions. On the transmission channel, there is evidence that the current hiking cycle is transmitting to financing conditions faster than previous ones. So you will remember that we use three three elements in our assessment. One is the inflation outlook, the second one is underlying inflation, and the third one is the strength of monetary policy transmission. On the third one, I think we all shared the same view in the room earlier today, that this channel of transmission is strong and stronger than we have seen in previous cycles. So when you look at how fast it transmits to various rates, whether it's overnight or whether it is longer term, it's extremely rapid. And it's reflected in the lending rates for corporate, in the lending rates for household, which I think I mentioned as 393, and in the monetary policy statement. There is a transmission, and it is having a constraining impact that is visible when you look at M3, when you look at the volume of loans, when you look at the interest rate. So it's really clearly the fact that transmission is effective, and more so than in the past. Your second question. So one of the bright spots that we have in terms of activity in the euro area is the labor market. The labor market is still going strongly. The employees' wages is growing. The employee remuneration is still increasing at 5.5%, and the participation has increased by 0.2%. We are beginning to see some signs of weakening in the volume of hires, and notably in some sectors that are related, particularly in the service sector that is related to manufacturing. We are beginning to see some signs. But overall, when I look at my numbers today, it's employees' remuneration plus 5.5, employees' participation in the economy 0.2 plus, and the lowest unemployment rates we ever had. So, and we're looking very, very carefully at that, because it's having a serious impact on inflation, particularly inflation in the service sector, which is typically much more labor intensive. Now, what are we seeing in terms of profit? When we look at profit unit cost and its growth, it is still growing. But that growth is, for the first time, having an inflection downwards. So that would comfort the assumption that we have made throughout. We made that at the June projection. We are making it yet again. It comforts the projection that gradually profit will squeeze in order to allow for the wage increases. We're beginning to see it. This is the first time. So we want to be confident that is a lasting component. It should normally be so, because as demand is dampened, it should normally be the reaction in the corporate world. Thank you.
Thank you. I think I saw Chiara De Felice of ANSA asking for the floor, right? Or did I not? No? Oh, no, that's okay. Then Eric Albert of Le Monde, please.
Thank you very much for taking my question. I'd like to come back on the housing market. You've mentioned, of course, that interest rate hikes have dampened the housing market. But how much of a drag on overall growth is it? How much of a systemic risk is it? And that might also be a question for Mr. De Guindos. And then in your first question, in your first answer, you were saying you could elaborate on how you reached the conclusion of doing a hike today despite the risk. Could you please elaborate? I mean, how do you reach this conclusion of yes, a hike is needed after all?
Shall I take the second one and then you take the first? Okay, so I'll take your second one. I'll take you through the reasoning that we adopted. We had indicated, and we are, bound by that intellectual reasoning, that we would approach the assessment using three key criteria: inflation outlook, underlying inflation, strength of the transmission of monetary policy. As I said earlier on the third criteria, there is no question in anybody's mind around the governing council table, if you want to sort of propel yourself into that room, there was shared analysis of that, with little variations at the margin. On the first item, which is the inflation outlook, well, we looked at the projections that were given to us by ECB staff. We looked at experts' reading and analytical work. And when you look at the projection, you see that, I was going to say, notwithstanding the GDP revision, we have a revision upward of headline inflation in both 23 and 24, and a 0.1 revision downward for 25, which is, hallowed with uncertainty, because the further out you go into the projection, the less certain it is. On the core inflation, which we look at as well, not only one, but we also look at core inflation. Core inflation is maintained in 23 and revised by 0.1 in 24 and 25. But overall, we are not at target in 25 on headline inflation. And we are almost on target on core, and we only hit around 2% in the fourth quarter of 25. So when we look at that, we ask ourselves, okay, inflation outlook, how does that compare with our commitments and our target? Not there yet. And as I said, it's the key sentence in that monetary policy statement. Under current assessment, with this decision of 25 basis points hike, we believe that we are making a substantial contribution to blah, 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 blah. I will not annoy you with repeating yet again. So those are the elements that we take into account. And then the real purpose of what we're doing here is not to be found in that sentence. It's somewhere else in the beginning of the document that you have, where we say, I hope I can find it for you right away. It's in the first paragraph, where we say, in order to reinforce progress towards our target, the Governing Council today decided to raise the three key ECB interest rates by 25 basis points. We want to reinforce progress. We want to be as timely as is possible. And by doing that, we support our projections with a higher degree of confidence. And I think it will reinforce progress towards targets. So we are determined to get there to that 2%. And we see that as the best way to accelerate the process. And by the way, it also reinforces the anchoring of inflation expectations, which are broadly at 2, but which warrant monitoring.
On how much of a drag is the property market for the financial system, Well, I will follow what the President has indicated before. I think that we have two different situations. In the case of the residential market, what we have started to see is that there is a slowdown in the evolution of prices in residential property. Whereas in the case of the commercial property, commercial real estate, the situation is different because we identified a decline in prices even before the tightening cycle of monetary policy. This was related to the situation of COVID, teleworking, and this kind of things. We have made a lot of analysis about the potential impact that commercial property might have in the financial system, and we have identified some channels, some links between commercial property, commercial real estate, and mutual funds that would reinforce the comment that I have made before about non-banks as a potential source of vulnerabilities for the financial system. I think that this is the element that we are trying to analyze. There are real estate funds, property funds, that have a lot of investments and a lot of credit exposure very close.